Broadcast is now starting. All attendees are in listen-only mode.
Well, hello, everybody, and welcome to the holiday edition of Turnout Tuesday. This is Ken Cavula from the Mid-Michigan chapter. We won't start quite yet. We're going to start in about 10 or 11 minutes, but now is the time to test your equipment. You can raise your hand and talk to us if you'd like. We have a questions box that's purely text-centered, so if you feel more comfortable typing a question, type away as it goes. Mark will be with us momentarily, and we're just kind of chatting right now. So if you have anything you'd like to chat about, anything you'd like to talk about, we're here to try to be of some kind of service. I don't know how sharp we are this evening, but we'll try to get some questions answered if you have anything going on.
I feel pretty sharp.
You feel pretty sharp tonight? Okay, good.
I do think...
Mark, I think I have it set, Mark, where you can start the recording at any time.
Treated here the last couple of months, and the opportunities that, in our opinion, are beginning to take shape in some of those excellent small company opportunities. And yes, that's why the rabbit is doing I guess that would be a paw palm, or would that be a face paw? Whatever. They're in the middle of the chart. And then we'll spend a little bit of time in the third session talking about our better selling thoughts on the rule of 5 and some of the disciplines we're trying to build and stick to on that. My name is Mark Robertson. I am founder and managing partner of Manifest Investing, one of the co-sponsors of these sessions. I'm joined here by my dear friend Ken Cavula. Say hello, Ken.
Hello, Ken. How are you all doing out there?
Ken is taking a break from his holiday shopping to share investment education wisdom with all of us, and we look forward to doing that. Our 2 emails are there on the screen if you need to reach out to either one of us. With that, let's kind of get underway. All right, you guys all know the disclaimer, but we'll go through it just in case you've forgotten. We're going to talk about real companies in real time, talk about philosophies and methods of the modern investment club movement put into practice by Better Investing, the National Association of Investors, and Manifest Investing. No investment recommendation whatsoever is intended. This is all about education. It's all done for illustration, and some of us do own some of the stocks we will be talking about, and we'll try to disclose that when we can. But again, please do your own homework. If you or someone you know would like to be added to the webcast reminder list, that is Natalie Cavula's email address at the bottom of the screen, ncavula1@comcast.net. ncavula1@comcast.net. All right, here's our agenda for tonight. It's a pretty simple one. Again, welcome, especially those of you that are here for the first time. Ken will be monitoring the back room, so if you have questions, you can either text them into the questions tab, or you can raise your hand if you have a functioning microphone and provide input. We do try to keep it fairly informal, and again, we're all trying to learn from each other and become better and better investors all the time. And that's what these sessions are all about. There are the 3 sessions we're going to talk about. We're going to talk a little bit about contests and the wonderful things that happen specifically, and we've just been through this with the small company effort. The notion of discovering ideas or opportunities for a closer look. We'll do a quick best small company update. We're having a rocky start, but that just means that there's probably some opportunities out there, and then we'll have our rule of 5 discussion. It is our intent to try to roll through these 3 topics, get them done, in under an hour, so we can have a little bit of open discussion time if there's anything else that would be on your hearts and minds here tonight. So let's go ahead and roll. Thought I would just provide some context. We've done this type of thing in the past. You're looking at the value line arithmetic average over, 20 years. 20 years from left to right there. That stock price bar that you see, again, that is the value line arithmetic average. So it's as if you took the 1,700 companies in the black or green book, the standard edition, and formed an index with them and then tracked their prices. And you can see that there are some speed bumps and some really big speed bumps along the way, but it's a pretty good picture from lower left to upper right. And with a little bit of a speed bump here over the last couple of months, as bad as it's felt, it's kind of tough to even see on this chart, I would argue. See it a little bit better on the chart down below. That's actually displaying the Wilshire 5000. That's the green shaded area behind the bars. And you can see the drop off here in the last couple of months. By the way, the stock market high was hit on September 20th, 2018, and it's been kind of a downhill slalom since then. And we actually tickled 10% for the first time in, what is that, Ken? Almost 5 years. The average stock return forecast, projected annual return, is now approximately 10% for the first time in almost 5 years. So just to give a little bit of perspective, stocks are sinking into the buy zones a little more often, but these are the times that try men's souls, and you have to take a deep breath, grit your teeth, and pursue opportunity while doing your Christmas shopping. Any thoughts on all of that, Ken?
Well, only to make the point, Mark, that 10%, that 9.5 to 10.5 range, that's been a pretty normal return if you kind of average things out over a long period of time, so that we're just kind of moving away from a really overheated market into a market that some might characterize, if they were looking at this from 5 years in the future, they'd be saying that's a pretty average return at 10% right there. So I'm not too concerned. I'm not too worried. I've lived through 4 or 5 very jarring markets, and what goes up will come down, and stock prices do fluctuate. So nice quotes for me to keep in mind and to reassure my partners with in the investment clubs that I sit on.
Yeah, and again, it maybe seems like cliche, but we don't buy markets. We buy stocks. And when markets behave like this, opportunities are created in individual stocks, and it's up to us to take advantage of those opportunities as they present themselves. And if you keep your head down and elbow some of those other shoppers out of the way, it can be done. All right, so let's go ahead and talk about stock picking breakfasts, stock contests in general. I've asked Ken to share some of the highlights of the last 15, now 16 years of their stock picking contest in the Mid-Michigan chapter. I've been privileged to witness and watch this unfold over the years. I will, despite some of the rumors and myths that you will hear, I do have stock certificates. I have winning, contestant certificates because they let me play along, and every once in a while my results are, you might say, lackluster. There have been years when I swung for the fences, and I guess it's swung for the fences, and I did not make contact. But other years I haven't done so bad, and I actually do have certificates. So
I could print up anything you want from my printer here, Mark.
There you go. I would appreciate that to make me feel good.
Okay. Well, we have been running this breakfast for 16 years now, and what's really unusual is a particular portfolio that we've been following for all 16 of the years. If you go to the next slide, please, Mark. This slide here shows the top stocks from the Stock Pickers 2017 contest. Our contest goes from November 1st of the year before to October 31st of the year that we're talking about. So this is a full 12-month return, and these are the stocks that did the best throughout the entire contest. Notice that not many of them today have a significantly decent par to take a look at going forward. In other words, they did really, really well in the 2017 contest, ate up a lot of their potential annualized return, and probably are not as decent an investment today as they would have been 12 months ago if you were sitting at the contest. I would say 13 months ago now. There's a lot of them on the list that are very familiar. And there's names on here that probably some of you have never even heard of before. But we always like to point these out. Talk to people about how well these particular stocks did and how you can find great ideas by kind of looking at the entries from all the different clubs that enter this contest throughout our chapter. Next slide, Mark. This is the portfolio, however, that's really very interesting. This is the Your Choice portfolio, and it's nothing more than the most popular stocks picked by the entries to the contest. We usually have somewhere between 30 and 40 clubs enter the contest, and these are the most popular stocks picked in the portfolios of those 30 or 40 clubs. This is the 2017 Your Choice, and you see it did quite well. If you drop that 1 up at the top in the value, then you can basically read a percentage growth during the year of the contest, and this particular portfolio gained a little bit better than 12% during the particular time that we're talking about. And again, that's November 1st, 2016 to Halloween, October 31st, 2017. Notice there were 4 stocks that did not make any money during that year. But the rest of them did. In a 14-stock portfolio, if you can pick 10 winners, that's pretty good. And a few of those winners are pretty healthy. A lot of these names are extremely familiar. We have clubs that swing for the fence trying to win the contest, but most of our clubs put together good, solid, better investing portfolios and then demonstrate the value of choosing stocks that fit our model. This up, straight, and parallel idea, it works, and it works in the relatively short term for larger groups of stocks, and it definitely works as you look at these stocks longer term. This portfolio beat the benchmark, and we'll talk about the benchmark value in just a second. We base our benchmark on the S&P, the Vanguard S&P index fund. We've been doing that now for 16 years, and we're very happy with how Your Choice matches up to that benchmark. Next slide, please, Mark. Here's the Your Choice portfolio for the new contest. There was only one stock that really gave us a double in the portfolio. There's a couple on here that are repeats, but we particularly point to Google as a repeat. And Google's a very interesting stock. We happen to think that you can do a great SSG on Google and that you can come to some good, solid, better investing conclusions about this particular stock. Look at the names of the other stocks on this list. It's pretty tech heavy. Remember when the list was being chosen in October of 2018, tech stocks were having some issues with their valuation, and so you're going to see the Amazons and the Facebooks and the Googles and the Nvidias of the world sitting on this list. But there's also some financials. There's a couple of retailers. There's a couple of stocks that deal with industrial products. So all in all, it's a pretty decent portfolio. And at the time of our breakfast, it had already gained almost 2%. I don't know what it's doing today, but I'm not going to check it. I don't tend to check this on a daily basis. And we urge our clubs to not watch TV and not check their portfolios on a daily basis either. To watch for the longer term trends and to find out what you're doing maybe every 2 or 3 months. Next slide, please. We did make the point at our breakfast. We spent a lot of time talking about the data that comes from Better Investing, the Morningstar data. We spent a lot of time talking about taxes, and we made a point that all of this tax falderall will pass. just as all one-time events seem to pass in the data that we're using. Remember that the Morningstar data is not adjusted. It follows the law, the reporting laws that have to go to the SEC. And so what you see is what the SEC gets. Unfortunately, that means that one-time events like extra taxes being paid or like other one-time events that might have happened in the farther past, those events are going to appear in the data. Here's a company that I own in a couple of clubs that I belong to. It's called Healthcare Services Group. The clubs that I belong to are pretty confident about the future prospects of this, but you see in 2014, everything except for sales take a big dive. And that big dive has to do with the fact that there was a one-time event. But it's not important for us to understand so much about the one-time event as it is to understand the fact that after the one-time event, the graphs go back to trend. And so it takes 4 quarters to wash that one-time event out as an outlier, but eventually your companies go back to trend if they're good, strong growth companies. You're going to see that problem occur with taxes, and then you're going to see that tax problem turn into something that looks just like this graph on an outlier. This one-time event was the company decided to self-insure in the 2014 year, and so took a one-time charge against earnings to set up their own insurance. Next slide. Here's a company that a lot of you might own, and again, the point is that after those 4 quarters of disruption because of a one-time event, the company, if it's a good, solid growth company, will tend to go back to trend. This happens to be Starbucks. In 2013, Starbucks had some legal issues. They settled the legal problem. They paid out of their earnings some fines to different entities. The legal problems were all settled. It didn't happen again. And notice in 2014, the earnings and the pre-tax profit and the net income lines are going back to trend, just as we might expect. It's an outlier once you get past those 4 quarters, and that's what's going to be happening with all of these amazing tax issues that right now we're wrestling with and we're swearing about and we're wishing that somebody else would adjust for us. Next slide, please. Here's the bottom stocks from our contest last year, the worst performers. And just as you might expect, many of the worst performers have pretty significant potential annualized returns going forward. They really underperform the market, and so that ups their potential for future years. It doesn't necessarily mean that these par numbers are correct. These numbers are generated from analysts' opinions, but when they match to a high-quality company, it might be something that you want to take a look at. I'm looking at the high quality attached to Skyworks Solutions 87, and I'm looking at the par of 16 on the day this slide was put together, and I'm saying to myself that that might be something I want to take a good look at. The same for the next one on the list, the 95 quality and the 15.7% par value, and going up a few, the 86 quality and the 17.1% par value. That's that's LCI Industries right there. Notice that 3 of our underperforming, our bottom feeder stocks from the contest weren't even in the database. That means they don't even have earnings. So we do have clubs swinging for the fence, hoping to make a huge, huge gain on a very speculative kind of stock. But I'm looking at a lot of these with very low quality ratings, and I'm saying to myself, I expect low quality stocks to not function as well in the market as high-quality stocks. Next slide, please. I just did a picture of Lam Research for you. Looks pretty decent. Here's this YY. This is a Chinese company. I've gotten my hand burned 4 or 5 times with Chinese companies, so this is something that I will completely stay away from. But if Chinese companies interest you, then this YY might be something that you'd want to take a look at. But again, I would check the quality, check the idea that quality does matter. And Lam Research, a very high quality company. YY, not quite so much. Next slide, please. Did you notice how many on these of these stocks had quality below 50? I kind of marked them out so you could take a look at them right there. That just says to me that we have people willing to take a chance in a contest. But when you find high quality and a decent par, then maybe over a 4 or 5 year period, you do have a stock that you might want to invest in. So there's even ideas to be found on the bottom feeders from the 2017 contest. Next slide, please. Well, here's that Your Choice portfolio again from the 2017 contest. Again, there were only 4 stocks that didn't make it. These are always great ideas. Here's the 2018 Your Choice portfolio. Next slide, Mark. Oh, I didn't even put it up again. I chose to tell you that this Your Choice portfolio has beaten the benchmark for 13 out of the last 15 years. That's a pretty amazing statistic. The Your Choice rate of return has been 14.9% annualized versus about 8% for the Wilshire 5000, approximately the same number for the S&P 500. But that 14.9 sounds awfully similar to the growth that we kind of expect our clubs to aim for and to keep in their portfolio over long periods of time. 15 years is certainly a long period of time, and to return 14.9% annualized means that if you followed that portfolio, you'd be doubling your money every single year over the last 15 years on average. Next slide, please. Here's the Your Choice portfolio for the new contest. You might want to take a few notes. We're going to have this portfolio sitting in this presentation, and this presentation will be sitting on YouTube, so you don't have to jot them all down right now, but there's some very interesting companies. And what I'd like to point out is the quality rating of these stocks in this Your Choice portfolio. Our folks like to swing for the fences, but they like to load their portfolios with high quality growth stocks. And I think when you find a group like this, with the lowest quality being somewhere in the 80s all the way up to a quality of 100, and when you look at the pars that go with those quality numbers, I think you're looking at a pretty decent portfolio. Next slide, Mark. If I were to look at these averages, and these are the averages that come from the Your Choice portfolio, I kind of boxed them in right there. That's certainly a par that's in the sweet spot. It's better than 5 points above the my par number, which when I put this slide together was 8.8%. My par has now moved to 9.9%. So we're getting into a pretty fairly valued market, I think. an aggregate quality of 94, growth of 14.8%. Remember, Mr. Nicholson said he'd like to see growth of at least 12.5 to 13%. So at 14.8, we certainly have some growth going on. Great financial strength, really decent earnings stability. I think that this portfolio just says, it just screams great, better investing choices. One more slide, please, Mark. Nice sector representation, a little bit tech heavy, but there's actually more consumer discretionary in that portfolio than there is tech. And then, nice choices throughout in various places there. One more slide. Because it's a contest, I would expect that they would have been choosing faster growers to put into the portfolio. And in fact, we're looking at almost 3/4 of this Your Choice portfolio growing better than 12%. Now, they're not small companies, but for our purposes in manifest investing, when we look at growth, we characterize companies that grow at better than 12 as small. We characterize companies that grow at less than 7 as large. And if the company grows between 7 and 12%, and that's sales growth, we characterize that as medium. This is certainly an aggressive portfolio. It wouldn't be exactly what I would suggest that a club puts together, but it has many of the characteristics that we're looking for in good, solid club portfolios. Next slide, please. And that finishes the kinds of things we talked about at the Stock Pickers Breakfast. It's a kind of a raucous affair. It's a joyous affair. People have been gathering for 10, 12, 13, 14, 15 years. They become friends with each other. The clubs know each other. They compete against each other and then come together and have a real good time at this breakfast. So we would invite you anytime you're near mid-Michigan in the second week in November to come join us up in Saginaw for a great time. We had over 100 people this last session, and everybody reports that it was one of our better sessions, but they say that every single time, so we're quite pleased, and our members were quite pleased as well.
That's because we're not getting older, Ken, we're getting better.
We're getting better, okay.
Well, one of the things I thought we'd do for the second segment here is we didn't talk about this specifically at this session, but we have in the past. This actually coincides calendar-wise with our efforts around Halloween to generate that best small company list. And this year, of course, I added the red rabbit, which led to the face palm there in the middle of the screen. Some of those small companies have been treated rather roughly by the stock market here over the last 6 to 8, maybe even almost 12 weeks. And the Russell 2000 has taken a pretty good shot. In fact, I think it was down at one point today between 4 and 5%. That's the Russell 2000, which is generally a collection of smaller companies. Now, those are small by capitalization, small cap companies, so it's not just small, faster growing companies, but it's a pretty good set of relatively smaller companies on average. And they have been getting hammered pretty well here over the last couple of months, creating some opportunity. We have written in the past about the January effect, which is produced by tax-related selling in the last quarter of the year as people get prepared for their taxes, where they will sell off a number of these companies. That puts downward pressure on the stock prices. Most aggravating to the smaller companies where they're impacted more by the tax-related selling. And George Nicholson every year would come out with a list in December of companies that he would be considering going shopping for in usually that following January or so. So again, it's just something to keep in mind that sometimes opportunities are created by things like tax-related selling. And in the case of our best small companies, here are the top 20 that made our list this year. Interestingly enough, since Halloween, while the Russell 2000 has been under some fairly serious pressure over the last little over a month, Ours have actually managed to keep pace at basically zero until today, during a period when the Russell 2000 and the Wilshire 5000 have been down a few percentage points. And what you're looking at here is the sort by highest projected return to lowest of those top 20 stocks. And you can see that stamps.com, which was on the Mid-Michigan Your Choice list for this year, in combination with some other companies like Health Insurance Innovations, HIIQ, they seem to have gotten even a little bit more compelling. I'd probably subject them to a little bit stronger audit. You see some of the slightly lower, still good quality, not excellent quality on some of those up at the top. But again, a decent shopping list that has been produced by some of that pressure. I do find it fascinating that Canada Goose is up 23-24%. Probably took a bit of a hit today. And one that I'm going to try to get Ken to consider carefully in the future, if I can talk him off of the ledge, is China Biologics. We've had some discussions during our roundtables about the biologics, and maybe there's something there. But the China Biologics did make it on our top 20 list for this year. And I had to persuade Ken to lock himself in the closet and chant or whatever you do in there to come to grips with that one. Simulations Plus is also on this list. Simulations Plus is one of Ken's favorites over the years. They do the DNA mapping software and process optimization software for companies that are trying to build the next cure for cancer, etc. So that's a pretty good one to take a look at. But these are all decent studies. Notice Five Below. I mentioned before we got started that Five Below has been one of the top performing stocks over the last 6 or 7 months. Thank you, Nick Strategos, for the multiple time selection at the round table, because it's done extremely well. Universal Display is back down under 100 again. And I personally don't believe that the large flat panel and curved panel screens are going away anytime soon, as well as some of the work that they do with cell phones. So, again, some opportunities are being created, and I would encourage you to take a closer look at some of these that have suffered a little bit. Any comments on any of those, Ken?
No, I really like this ASR mark, and I would urge anybody that is doing a dive into these stocks to consider this ASR. They run this sounds like a really strange business model, but they run the concessions for a single airport in Mexico. It happens to be the airport that serves the Cancun area, and these concessions for that airport are extremely lucrative and appear to be growing without any kind of cap to them. So I would take a real serious look at this ASR as something that's really out of the ordinary, and at the same time has a pretty understandable business model.
Yeah, and one that I would point out also that has received some coverage at our roundtables, it is up 11% as of yesterday. Again, that's 11% over the last month, is IPG Photonics. Again, in laser-related businesses, we have come out with presentations on Coherent, IPG Photonics, and a couple other I can't remember off the top of my head. So it's a theme area that we've visited a number of times on the round table with a number of companies, and again, probably a decent study to consider the theme and opportunities longer term. And of course, in the information management or technology consulting area, you do have EPAM Systems, which has been a very solid performing selection that was made by Cy Lynch a couple of years ago at the National Convention, and it fits into that same mold as Cognizant Technology, Infosys Technology, Accenture, those type of companies, and certainly worth a closer look. And it's actually, even with this fairly large gain over the last month, still in a pretty decent situation for further consideration. So we'll just close with one last thing. You can do this if you're a member of Manifest, and This is just a quick screen looking for companies growing faster than 12% with a manifest rank greater than 98. Now, keep in mind, the manifest rank is simply a two-part parameter, if you want to think of it that way. At Manifest, we believe that the two most important characteristics of any investment, including stocks, are the return forecast and the quality, basically these two columns. So we take and build a parameter, an index, or whatever you want to call it, basically giving equal weighting to those two things, and we're looking for that combination of excellent company at an elevated return forecast. Again, better companies at better prices. And that's what we do nonstop. What you're looking for here is by setting this at 98 is the top 2%. And again, the first and second percentile of the 2,400 companies that are in our database. And then you're going to shop amongst those that are growing at 12% or more, just to isolate some of the faster growing, generally smaller companies. And stuck the financial strength rating of 70, that would be equivalent to a minimum acceptable rating of B++, if you want to think of it that way, at Value Line. And you end up with a pretty decent shopping list, including Facebook, which is having its fair share of challenges right now. Align Technology with the invisible braces. C-Trip, again, a Chinese stock, which Ken is having a hard time with these days. But those stocks have been absolutely massacred over the last year. All of the Chinese stocks pretty much have. And some of those have pretty decent looking business model perspectives. Amazon up near
Mark,
the top. Yes, sir.
Mark, we have a couple of people that would like you just to explain the acronym PAR again. They're just a little confused on that acronym.
Yeah, PAR stands for projected annual return. And then that's taking a look at that 5-year time window, doing everything that you would do during a stock study using a stock selection guide. And the PAR is one of those measures of return expectations that you have in section 5 of a stock selection guide. The difference here is that this PAR, this projected annual return, is the return forecast that would be built by a consensus of the analysts who follow the company. Keep in mind that we follow very closely the output from organizations like Value Line, Standard & Poor's, Morningstar. We watch the analyst consensus, and there's a couple other things we look at, but we basically subject them all to what you might think of as a consensus stock selection guide. Again, doesn't mean they're right, but basically factoring in the expectations of that group. And that's how we end up with that number, to give you a fairly solid second or third opinion as you're looking to validate some of the results of your own forecast building. And so again, from top to bottom, this is a pretty decent shopping list. And again, with the January effect in place, you see Simulations Plus on here. There's other companies like that. It's highly likely that you will be presented with buying opportunities, and this is the type of screen that will flag them as they become available. And I basically have been committed to watching this on a much more frequent basis than I normally would. I've got a little bit of cash to invest of real Mark and Wendy money, so we are watching this type of a screening output for opportunities to take advantage of the January effect here in the next quarter or so.
I want to make the point. Yeah, I want to make the point, Mark, that the January effect also leads me sometimes to sacrifice a company that I have a lot of faith in December, wholly expecting to repurchase the company in January. If 31 days can go by and the company stays essentially flat or even falls a little bit further, I give myself permission to sell, especially in November and December. I don't have any problems with building up a little bit of cash to buy stocks in January or February or March. And there are a couple of stocks on this list that I am going to sell from my portfolio, capture the capital loss, and then fully intend to purchase again come January. I have to wait 31 days. So I will dutifully wait what the law says I have to. but I'm not above doing a sale for the tax purposes, and I don't think any of you should get so stubborn that you can't get rid of something that's a loser, and then give yourself the discipline to buy it back if all the fundamentals are still in place 31 days from now.
I agree completely, and haven't done a lot of that in recent years. Haven't had the opportunity, thankfully, but it can make all the sense in the world. So you're holding down the price of all of our stocks, as we can.
That's it. That's it.
All right, we've got a few minutes left before we open up the floor for questions and answers. I thought it would probably be a good idea, and Ken agrees, for us to, as we talked about during the most recent roundtable, to go in and do a little bit of wide open soul searching and contemplation and consideration of this notion of selling better, and specifically the rule of five. We'll talk about what it is here in a second, but again, this notion of developing not something new, but something that's complementary and perhaps a bit additive or reinforcing to our selling disciplines that we have had in place for now the better part of 7 decades. So we're not talking about messing with any of the stuff. And the other thing that we want to make clear, and it'll be clear by the time Ken and I are done scratching each other's heads, that this is a work in progress and an experiment. And we're trying to basically take some stuff that we have known all along instinctively and build it into something that's a little bit more of a steadfast discipline, if you want to think of it that way. So let's go ahead and talk about this one that came up at the most recent roundtable. It's this rule of five trigger that we have kind of stumbled into. The rule of five is just simply the real life expectation that if we pick 5 stocks, 3 of them will do pretty much what we expect according to the results of our stock study. 1 will outperform our wildest expectations. 5 below might be an example of that. I think that's probably doing even better than any of us would have expected. And 20%, 1 out of every 5 will be disappointing. So therefore, everybody hold your right hand and say, I will not be surprised when 1 out of every 5 of the stocks that I pick actually misbehaves. And it's just a reality. And David L. Babson is credited there with basically presenting the rule of 5 to better investing. It's become part of the literature over the last 50 or 60 years. So again, we see this type of thing in all of our tracking portfolios and our case studies, basically about that 1 out of every 5 misbehaving, and we think making it eligible for what you might think of as a timeout. Again, the approach that we're talking about here is that, rule number 2 there, when you have unexpected or inexplicably bad performance, we want to try to set some type of a trigger to take a closer look and give it selling consideration. And we actually modeled our thinking after the work of William J. O'Neill. He's the guy who created Investors Business Daily. And again, it's a different style of investing. I'm not going to say this is bad. It's not something that we would generally agree with, but they generally tend to do more of a momentum-based investing in stocks. So this type of rule, where if your stock goes down 7 or 8%, they sell it. No questions asked, no jury, no judge, you just sell it. And our assessment of that, as it might apply to that which we do in the world of better investing, is that 8% would probably be too low for the average stock. I mean, think about it. The stock market went down 3 or 4% today all by itself. So, I mean, that would have triggered a number of these in a number of portfolios across the country. So, again, we want to think about, this notion of, how's my stock doing compared to the overall stock market? If my stock went down 1% today, while the market went down 3 or 4%, that's actually a pretty good day. And over the longer term, just as it says here, if your stock drops 10%, if the market drops 10% and your stock only drops 8%, that's not that bad of a situation. Not pleasant, but not the end of the world. So again, we came up with this rule of, let's come up with a fairly simple way to flag or trigger decisions that we make. And any time that your stock, the decision that you have made, lags the market by 20% or more, we're basically going to flag or trigger that stock for a closer look, and we're trying to stick to this discipline. Anything you want to add to that, Ken?
Well, I want to make the point that I'm enough of a scientist to understand that if you try to have too many variables in an experiment, and if you try to change 8 or 10 of those variables every time you see a slight glitch in whatever's going on, you're never going to be able to test whether one of those variables is really doing anything to what you're trying to affect. That's a long way of saying I don't think that what we're doing right now is open to survive a lot of arguments from all different sides about every single variable that goes into selling a stock. We've laid out a plan to test a very specific idea, and we're trying to collect some data on that idea right now. And in order to test that idea and to collect some data on that idea, we sometimes are going to be forced into a position to do some things that don't make as much sense to some of you that are trying to put everything all together into one giant uniform field theory. There isn't, in my mind at least, one giant unified theory that's going to make me a better investor. Rather, there's a lot of ideas that I can hopefully keep generally moving in the same direction that are going to end up making me successful. So when we're doing these trials, these tests, we're in the middle of an experiment. And you can't go rushing in and changing 4 other variables in the middle of the experiment and then still say you're testing the first variable. So right now we're testing this idea about rule of 5. We've picked a number, 20%, when the relative return gets, 20% less than what the market is giving. We think that's a place that we're going to sell, and we're grappling with some of the other ideas that are being presented to us, but we're trying to stick to our discipline so that maybe 2 years from now or 3 years from now, we've been doing this for about 1.5 years, 2 years, maybe in another 1.5 years, 2, 3 years, we can say, this rule makes a lot of sense. Let's adopt it for real portfolios. Or we could say this rule makes no sense, or we can adjust the rule so that it begins to make some sense.
Wow, you really brought up unified field theory?
I certainly did.
And you're picking on me for going beyond algebra? I wrote a college thesis on unified field theory. That was many decades ago, but oh well. All right, so here's some of what we're talking about. During the November roundtable, again, we track in the database and flag anytime a company drops more than 20% in the market. So those top 2 possessions are Ardelyx. Those are Hugh McManus speculative situations that we basically give a free pass. We refer to it as a speculative pass. We're still trying to figure out, frankly, what to do with that. Whether you have a shorter leash, longer leash, we still don't know what to think of some of Hugh's ideas, although we're really grateful for Hugh. And Hugh has had some spectacular returns. But some of the other positions that you see there, LCI Industries, which I think is the one that Ken was talking about, that he might take a tax capital loss on and then possibly buy it back, because we still do like the company. Alliance Data Systems, Skyworks, and LKQ have all dropped slightly more than 20% more than the market. Again, this was as of right around Thanksgiving this year. So again, they dropped over that threshold, and we have a really hard time with that being a hard and fast line in the sand. But at the same time, we do want to enforce this discipline, because you can actually go back and listen. I believe it was in September we got emotional and hung on to a stock that proceeded to drop another 30 or 40% over the next month. So we do want to try to instill this discipline and stick to it. So we did go ahead and sell these, but it kind of prompted a number of questions, including what you see there. Is 20% the right number? Should we be talking about 2 different numbers, not just 20% by itself? Should there be a number for core and a number for non-core? How should we think about that situation? And what about the fact that we have 7 times we've made a decision to add Alliance Data Systems to the portfolio, and this is one of the 7 decisions. And what do we think about that? And Cy had a few thoughts that we'll share as we take a look at that. But This is kind of what erupted. Your thoughts on this, Ken?
Well, Mark, we have one of our regulars that's having a brain freeze and would like us to explain these numbers that we're talking about. So I'm going to jump in and I'm going to do this for, I won't even mention her name, but she knows who I'm talking to. And I'm going to do this for the second Artilex position because the arithmetic's going to be fairly easy, okay? The total return for that second Artilex position is negative 30.1%. That means that of the $1,000 that was there, there's 30.1% less today. There's about $699. That 30% would be $700, so we'll take off the extra buck for the 0.1%. The relative return is the difference between what this stock has given us and what the overall market has given us during the same time period. Notice this is a particularly new position. It's only 10/23/2018. So we're going to measure a very short history of the market. And because the relative return is 31.1, the market must be giving me a plus 1%.
Until today.
Well, I'm not dealing with today. I'm dealing with this slide, okay? So if I go from plus 1 to negative 30.1, I get this relative difference between what the market gives and what this stock is giving of that negative 31.1. I had to move down, hence the negative sign, and I moved down from positive 1 to negative 30.1, and that gives me the negative 31.1. The arithmetic's the same in every single one of these. Let's pick one more. Let's do the second Skyworks, Mark. And the second Skyworks, the stock itself is giving me negative 26.2. It's worth $738. The relative return is negative 21.3. That means the stock is falling from around 5% negative to around 26% negative. It's going from negative 5 to negative 26%. That's what the market's at the negative 5. The stock's at negative 26, and the relative return, the difference between the market and the stock, is negative 21%. I hope that helps our regular out there in the audience understand where these numbers are coming from.
And I think I left the market returns on the next slide, so let's go ahead and jump over there.
Okay.
I did. So you can actually see the difference between the two. What Ken was doing is comparing the numbers between that last column on the right, that's the return on the Wilshire 5000 since the purchase date, and comparing that to the third column from the right, the total return on the actual stock. The difference between the two is the relative return. I think you can see the numbers there that Ken was actually showing you. So this is in response to the question that came up as Alliance Data Systems was flagged at that minus 21.5, but we also know that there are 6 other decisions or lots in Alliance Data Systems, and the question that came up is, well, what do we think about those other 6 positions? And I'll give you my opinion or my frame of reference on this. Ken, you can jump in with yours, and we'd be interested in hearing the audience. Insofar as what we're talking about testing and demonstrating, I'm not so much worried about the portfolio. I'm not worried about the individual lots as they are identified. I'm talking about taking a look at hundreds of decisions, individual decisions made. So I look at this chart as 7 different decisions made. Now, some of those were made by two people on the same day, as you can see down below there. Kim's motion was seconded by the audience, both in, well, that's actually around the National Convention back in May 2018. So that's why there are 4 choices down there at the bottom. So I basically treat this as, how is that decision working out? That stock that was selected by Cy Lynch on October 24th, 2017, and was sold via the discipline on 11/27/2018, when it did actually drop down to minus 21.5. And I guess I'm not as troubled by the fact that it's one of 7 specific Alliance Data Systems transactions. Now, I will share with you that I don't think Cy's here tonight. Correct, Ken?
I didn't see him, Mark, no.
So I'll paraphrase or try to capture his sentiment. He says, all right, I get you. I hear what you're saying. He says, however, how this fits into the bigger picture. In other words, was it the first selection of Alliance Data Systems made, or was it the one made most recently? That would probably weigh more heavily on a decision to just sell the entire Alliance Data position, if you begin thinking of it as the 7 lots. And I get what he's saying there. This happens to be one of the older, it's a little over a year old position in Alliance Data, so that it doesn't really fit that bill. But I get what he's saying. If you were looking at 6 previous positions and the more recent one, well, it was really not working out, was behaving in true timeout fashion via the rule of 5, maybe you do give some thought as to selling the entire position. I'll tell you, in terms of managing a portfolio or whatever, I don't think the accounting is a challenge for anybody. You can actually select lots. I like the notion that this is allowing me to isolate the one decision, sell it. It actually has one of the bigger tax loss potentials of the 7. So if we were talking about tax-related selling, that makes sense. But I really do tend to think of it as almost a bit of a hedge. The 7 positions that have been selected in Alliance Systems, something is just not behaving very well or whatever. And I'm very comfortable just treating it on a decision by decision, picking out a specific lot and selling it. Your thoughts, Ken?
It goes back to what I just said, Mark. If we add too many variables to this grand experiment, we're not going to be able to test anything. And while I understand what Cy is saying, while I understand what some of you are saying in the question box right now, I think you're not understanding what we're trying to do. And we're trying to come up with another trigger to help us sell better. And this trigger is aimed specifically at the rule of 5 when we've had no real good reasons to help us decide whether to get rid of a rule of 5 stock. I understand when our friend from Western Michigan says, if the whole industry is under attack, shouldn't they be getting a pass? And you should be looking at places where management of the company is much worse. I think that's moving into traditional selling, and we've already made the statement that we don't disagree with any of the traditional selling ideas that go on in better investing. What we're looking for is a way to preserve capital. And right now, our data that we're collecting about this rule that says jettison a position when its relative return reaches negative 20 or lower, when we start to parse that data, we're finding some very interesting information, and I think the next couple of slides might be of extreme interest to those of you that are following this grand experiment that we've been in the middle of now for about 2 years.
Yeah, and I agree. I think, again, it is a work in progress. I mean, we'll come back to that slide in a minute. Here's what we're beginning to see. Again, as I go back over literally hundreds of transactions for the roundtable, and in those situations where we do sell, now I want to be very careful here. We're not talking about back testing, because that's so tempting. I want to go back and pretend like we sold fossil after it dropped 20%. But no, we were still hanging on to fossil after it dropped 80 or 90%. I'm not going to go back and do that type of a back test. But what we're talking about here is if we do the rule of 5 discipline, the transactions that we actually make during the roundtable, we end up with that return of about 17.5%. That's a rate of return over approximately 8 years. If I go back and I say, all right, let's just pretend that we didn't do the rule of 5 transactions. In other words, we didn't sell Iconics when it went from 40 to 2. And we certainly didn't sell it when it went from 40 down to, let's say, $36 a share, or whatever the number would be. What if we just simply were not doing this rule of 5 trial or experiment? The number drops down into the 13 to 14% range. I think the number is going to be fascinating. As I'm sitting there watching and looking at, the fossils, the Iconics brands, and all these, we have so few times when it came back and bit us. In fact, with hundreds of cases in our case study now, there's actually only a couple of situations. One of them was Oracle. In one of our other studies where Oracle came back. It's just not happening. What typically happens is the Iconics brand story, where it went from 40 down to 20, down to 10, down to 5. It's kind of the trivia answer to the question, how many times can I lose 80% on one stock? And the answer is apparently 5 or 6. Because every time I look, it's lost another 80%. It's just amazing. So these are the type of stocks that we want to isolate and walk away from, during that first period of minus 20% underperformance. Again, if I go back and I say, all right, we're just going to ride them. We're just going to keep the fossils. We're going to keep the Iconics brands. That's where you end up with the red bar. So I think there's a compelling number of percentage points there. And certainly something where we want to go full speed ahead. Do we want to possibly keep it as simple as possible and fine tune it? Absolutely. We want to figure out the answers to those questions, while at the same time honoring Ken's wisdom of we don't want to introduce too many variables. We want to keep it as simple as humanly possible, but we do want it to make intuitive sense also.
Yeah, and we don't know how many data points we need, but instinctively we're saying that the 100 or a couple hundred data points that we have so far, while it's becoming compelling, it's still not enough to base a decision on. It's the same kind of an idea when they do a drug trial. How many people do you have to test that drug on before you're convinced it has a beneficial effect for the problem that it's supposed to solve? So I don't know the answer. I do know statistically how to figure out that answer. And when we get close to that sample size, then I think I will become more comfortable with the probabilities that this idea is actually beginning to work.
Yeah, and we do have,
and we don't know how long that's going to take yet.
Yeah, we'll build it out as long as we need to, and we certainly have ways to statistically measure when it's potentially meaningful. Well, that's a lot of. How many buzzwords did I pack into that sentence? But
we can pack a bunch of them. We can baffle you with mathematics if you need that, guys. Okay.
Well, you're the one that said unified field theory.
I know. I regret it already.
I will point out that we are seeing very similar results with the Fave 5 tracking portfolio. That's got a relatively high volume of transactions, so we are going to see some interesting stuff, and we'll be out with something on that here fairly soon. But hopefully this gives you somewhat better idea of some of the issues that we are facing as we conduct this derivation, if you want to call it that. Ken asked me before we got started, well, what about that next position down on ADS? What if it goes to minus 20 or worse at the December roundtable? And my position is you sell it. You simply stick to the discipline and you walk away. Again, I think of it almost as again acting on a single decision. It does give you hedging on, if you want to think of this as a 7 decision position. And again, it's it's a fairly compelling strategy to me. And again, I'm closer to the numbers than perhaps anyone, so it's kind of interesting to see the anecdotal results that we are getting so far.
We've we've actually silenced the question box, Mark. So they're either amazed or they're completely confused. I'm not quite sure what it is. Nick is saying to us, I think it's a good theory. I think the difference between a tracking portfolio and a club personal portfolio is going to eliminate, in many cases, the multi-lot situation. Nick, you probably were eavesdropping over our shoulders when we made that exact point to each other before the meeting even began. We not only talked about club portfolios, we talked about personal portfolios. I don't have a lot of multi stock purchases of the same stock in my personal portfolios or in most of my club portfolios. And Mark indicated that he didn't as well, right, Mark?
Yeah, I would say the same thing. I'm doing a little bit more with Robinhood as I put it through its paces, which is a subject for another day. But yeah, I do have a few multiple positions there, but that's the only place that I can think of. It's not true in any of the IRAs, with the exception of a couple positions in Apple, perhaps. So it's not an everyday thing. But again, I come back to whether you're using portfolio record keeper, whatever Matt's calling it today, for individual investing, or the club accounting software packages. This is all fairly stuff that's easy to do functionally anyhow, as far as selection of lots. So maybe it is something that has some bearing. The other thing that kind of erupted out of this that we talked about just a tiny bit was this notion of noticing the range on the projected annual return, the high and low range that you see on the chart of, again, here are the highs and here are the lows. And maybe for a company like, just throwing it out there, maybe for a company like Alliance Data, you want to like it better when it's up closer to 20 than down around 12 or so when Cy added that position, which was just removed. Just something to think about, something we might talk about in a little bit more detail. Ken asked me, well, how would you actually put that to work? I said, well, I'd do my study, I'd come back to here, and I would look and see if I could see a range like this. And just think it through. If you're talking about Johnson & Johnson or Aflac or Microsoft or a company like that, I do think we tend to see these kind of tight ranges where, in the case of a Johnson & Johnson, for example, 12 is actually a pretty good number. 12 would be a much better place to buy for Johnson & Johnson than apparently for Alliance Data, is kind of the way I would frame that. A 12% par.
Par value, yeah. Mark, let's go into our questions, because we do have a few questions right here, okay?
Okay.
Lisa would like to know, why do you wait 31 days before you rebuy a stock that you sell in December? Lisa, that's just to meet the law. The law says that I can't sell a stock today and buy it back tomorrow if I'm going to claim the capital gains from it or the capital loss from it. So I'm going to sell it and then wait 31 days, and then I can claim the capital loss as part of my taxes. John wants to know, how would you factor in the added risk of owning a Chinese stock given all the trade problems? Mark, I don't factor it in because I refuse to buy them anymore. So the question's yours, Mark.
You're chicken. How would I factor in? Run that by me again.
The question is, how would you factor in the added risk of owning a Chinese stock given the trade problems?
That's a tough question. I will tell you that I can't be any more specific than apparently caused all the trouble that happened today. Apparently 2 days ago over dinner, they made some type of very generality-based meeting of the minds and agreed to do something about the tariffs in general between the United States and China. And apparently the specifics were lacking, and that's what drove everything crazy today. I don't know. That's how I don't have any more specifics than that. I tend to think of it much more longer term. The trade challenges with China have been a constant over the years. Do I think that there's potential for it to improve ever so slightly? Yeah, I actually do. I actually think that China wants to improve the situation, as does some of the other countries in that region. So I do think that there will be improvement. How would I factor it in? Same as I would with anything else, with just adhering to the results of a stock study, maybe conditioning it to temper or moderate some of the analyst expectations for a particular company. There is no specific answer, in my opinion, to that question. I would be as cautious as Ken, and probably stick to some of the more liquid and invisible companies. Keep in mind that some of the world's finest minds that operate hedge funds have been incredibly deceived over the years by some of the companies over there. So again, I think size does matter, and liquidity and everything else.
Yeah, one of my good friends from Pittsburgh, Herb Barnett, has reminded me that the 31-day, and I knew this, Herb, I just didn't make it real clear, reminded me that the 31-day rule applies to capital losses. It doesn't apply to capital gains. If you sell a stock for a capital gain on December 14th and want to buy it back again on December 15th, you have the right to do that. But if you're going to claim a loss, then you have to wait that 31 days to make the sale. I'm going to ask our audience if they can help with this next question, okay? Because I think I know the answer, but I'm not positive about that. John says that his broker shows all of their sales as first in, first out. And I'll agree with John that my broker does the same thing. John thinks that we can't sell specific lots. I thought that we fought this issue a year ago or 2 years ago, and the ability to designate particular lots, as long as you kept your own records, was still you still had the ability to do that. Can somebody out there that maybe has some CPA background, and we're getting answers right off the bat, and everybody is indicating that you in fact do have the ability, if you wish, to specify lots. Some of the brokers even allow you to do that. I'm hearing that TD Ameritrade allows you to do that, and that's why I was surprised when John said that he didn't think anybody could do it, because I know I can do it on my TD Ameritrade account. We're getting that Schwab allows the same thing, and we're getting a number of folks that are telling me that you can do that. So, John, if your broker doesn't allow that, you'll have to keep records yourself as to which lot you're selling, and if you ever should be audited, then you'd have to make that clear. That means that your records might not agree with your broker if your broker is going to insist on first in, first out. But I think that it still is something that you can do. I know that Better Investing got involved with this issue a couple of years ago, and I thought it was settled to our advantage. Okay, I'm looking at other questions that we might have now. Mark, this one's for you. This is from Bill out in Arizona, okay? He says, your projected PE ratio gets a little extended in some cases. Do you place any restrictions on your projected PE ratio that you use in Manifest?
Yes, rarely. Basically what you're seeing there is the analysts that cover the company getting a bit frothy. Whether it's Morningstar, S&P, Value Line, or the analyst consensus, sometimes they get a little bit carried away, and they'll take a company that might have a projected average PE of 30, and they all check in at 45 or 50. For next thing you know, the consensus is 48. I think that's the type of thing you're talking about. The other place to be cautious and wary is companies that are very early in their life cycle, like an Amazon. where the earnings are just breaking into positive turf, and you basically have elevated PEs, which aren't even really PEs. They are, as Value Line is more apt to do, as call them NMF, not meaningful. In the early stages of the life cycle, PEs are very misleading due to mathematical challenges.
Well, we've done a good job here, Mark, of clearing up. We didn't. I thought we did. I thought we cleared the question box. I have a question from Karen here. She says, would you please have Mark go through those screening criteria again, as you talked about earlier? How did you screen for that set of stocks earlier, Mark?
Okay, why don't I just go ahead and do a live demonstration? And what I'll do is go into a stock search, create a new stock search at Manifest, and all I'm doing is, first of all, my Ivory soap screen would normally be 99.4 down here. We're going to take the top 2% and do 98 for the Manifest rank. So again, that's the top 2% based on the return forecast, the projected return, and the quality. And then I'm going to insist on more rapidly growing companies. And that's, I'm putting in a greater than 12% growth rate, just so that we have faster growing companies. And then just simply because the market is the market, going to put in a 70 for a B++. In fact, let's do A and above, 80, just to show the difference. And we'll be using tonight's results now. And you see we get a fairly decent list. I must have been using tonight's on the slide. So again, we're looking for companies that are ranked at the top according to their return forecast or par and their quality ranking, in combination with a growth rate faster than 12% and a high financial strength. So I put in 80 for a minimum financial strength, basically 8 or better. A pretty good shopping list. I think Ken would agree that that's
it's a superb shopping list, Mark. Yeah,
a good one to drag across the coals, looking for an opportunity.
Yep. Well, I'm looking at the question box. It's empty at the moment. I don't see any hands raised. So we're going to wish everybody a Merry Christmas. We are going to be back with the roundtable on December 29th. And that'll start at 11 o'clock Eastern in the morning. That's a Saturday, 11 in the morning, December 29th for the next roundtable. And we'll announce when the next Turnout Tuesday is at that particular time. Merry Christmas to everybody. I hope you have a wonderful, wonderful holiday. And Mark, I hope to see you and Wendy before the holidays, and hope everything is going okay with everybody in your family.
Well, thank you. We'll make that happen.
We'll talk to you later. Okay?
All right. Merry Christmas, everybody.
Merry Christmas, folks. Bye-bye.
Holiday season. Bye-bye.